Macro investing provides access to markets that our clients otherwise wouldn't be involved in. And it provides it with professional traders who have the expertise to potentially profit from events around the world, whether it's a change in foreign exchange rates, whether it's a change in yields or what's happening in equity indices. It's just not correlated to what's happening in the other parts of people's portfolio. And in stress periods and in crises, it's been managed to provide some pretty impressive returns against a backdrop of things that aren't working elsewhere. I think of Graham Capital as a pioneer in macro trading, as a firm that has a rich history of 30 years of investing in macro for our clients and trying to always innovate and come up with new and creative ways of generating sources of return that clients would not access elsewhere. Graham has 3 different offices, one in London, one in Florida, and the main office here in Connecticut. We want to be a global firm, not only in the markets we trade, but we also want to provide access for talented people to work where they think is the most conducive for not only their lifestyle, but their careers. As I think about one of the attributes of Graham that's somewhat unique is how Graham is involved in both quantitative trading and discretionary trading, is better than only one or the other. But it's also very important to have the synergy between these 2 very different ways of approaching the markets. And I think it's unique to Graham. There aren't so many firms that approach it the way we do, which we have our quantitative models and we have our people, and we have both sides of how we manage capital working together at times to try and accomplish the best overall results.
Humans have an advantage when markets are very volatile because they're very tactical and very short-term oriented. Thinking, reading, analyzing markets, and then coming up with trading strategies to profit from those views and from that data. On the other hand, systems, quantitative processes have the ability to look at an enormity of data, structured and structured data, and then come up with very robust statistical tools to forecast markets and build robust portfolios. There are advantages to each one of these styles. When things are changing really fast in a very complex way, humans might be a bit better at the game still. When things are more stable and you have to process an enormous amount of data, then machines can be better. Institutional investors have portfolios that are long-term in nature, right? And that they have this very heavy stock allocation and bonds that sometimes don't provide a hedge. Our role is to provide a strategy that would be not only producing returns, but keeping that nice negative conditional correlation to the portfolios of institutional investors. So as a hedge fund, we are very focused on providing alpha. We don't want to charge clients for piling up on the risk that they are already taking. That would be bad in itself because we wouldn't be providing a solution, and double bad would be to be charging fees for taking a risk that they can take in a passive form or an easy to structure form.
Since the inception of Graham, we've been using advanced techniques. Some are statistical, some are machine learning in nature. We have experts working not only in machine learning, but also in economics and financial theories, all collaborating together. The alpha research process at Graham starts with idea generation. And idea generation happens both at the strategic level, as we discuss individual client needs, and at the bottom-up level, as we find patterns of market with their data. Once the ideas are generated, researchers essentially solve complicated word problems by casting them into mathematical formulations. From that point on, it is data-driven and evidence-based. We combine numerical data with use text-based processing, and these will allow us to respond to geopolitical events and detect disruptions in the supply chains. These typically allows us to trade faster than waiting for the inventory reports to reflect the new reality. In recent years, we started using neural networks in connection with natural language processing. So these days, people call them AI, but we just call them good quantitative methodology.
One of the keys to success is having the best people. So we've tried to create a culture at Graham which really rewards creativity and innovation.
Graham is a really special organization. Our culture is deeply rooted in collaboration, innovation, inclusion, and integrity, and these core values are really upheld in all that we do. The Employee Advisory Committee was created because the senior leadership at Graham really values the opinions and perspectives of all team members and wanted to ensure that all employees globally at the firm had a voice and that voice could be heard. I think it really does speak to the longevity of the organization and the stability of the firm, and the fact that people can come to Graham and start careers and ultimately grow them long-term over time with a sense of fulfillment, enrichment, and reward. So we invest a tremendous amount of time and energy and resources into developing our people. We recognize as a firm, without the best people, we cannot truly be the best firm. The physical and mental well-being of our team members is critical to their performance and satisfaction with the firm. To show our commitment to the health and well-being of our employees, we have on staff a full-time director of health and wellness. That individual, alongside with senior leadership, works to create specific initiatives and programs that are offered and available to all of our team members. That is just one specific example of an initiative that we help to support, but we do many things to give back to our local community as we view it to be critically important. We host things such as toy drives, clothing drives, used sneaker drives.
For Graham to have accomplished the success we've enjoyed for 30 years, the things that make sense to me that are the building blocks of our ability to achieve success in very different market cycles. One is the diversity of different approaches we have to generating returns to market and different sources of alpha. There are times where our discretionary traders are going to be very effective, and maybe our quantitative models less so. We don't always get it right, but there have been a lot of market events in 30 years that you had to be pretty skillful to overcome. And through some combination of risk management, we've been able to weather some of these tough times and actually in many cases benefit from them. There's got to be some balance between being really creative, really innovative, really thinking about what's next, but also having some restraint to not overreact to all of these different factors.